mode.
Good morning, or I guess afternoon, to everybody. So we'll get started here in just a couple minutes. As per usual, I want to give everyone a chance to catch it from the beginning, so I'm not going to start right this second. We'll give it about 3 to 5 minutes here before we jump in. For those of you that are in here, if you could do me a real quick favor and just kind of let me know if you're able to hear my voice and see the screen. Perfect. So we're going to be talking a little bit more about Forex today and kind of the trading plan that I use for trading Forex. And we're talking mostly in the context of binary options, but there is a couple of examples that we can go over that are kind of more appropriate, I think, for the spot market, because I think that what's nice about binary options is if I have a solid trading plan for the underlying, like if I have a solid trading plan that I would take and just apply to, say, the Aussie dollar spot currency pair, well, I can pretty easily translate that into a binary option strategy, and I can even more easily than that translate that into a Nadex spread strategy. So it's a good way to think about how to use these products, because if you have a trading strategy that you're already using, say, and it doesn't necessarily have to apply just to Forex, but say you're already using a strategy and a plan to trade, the S&P futures as an outright. Well, it's not that difficult to turn that into something that makes sense and can be traded with the binaries as well. So we'll be getting started here in just a second. Yes. Okay, yeah, so we're going to go ahead and get started then. Alrighty, guys, so we're going to be talking about building a complex Forex trading plan. And I call this a complex plan because sometimes we're going to look at our setups and make a decision about what the best approach is going to be. And sometimes the best approach might be to use binary options. Sometimes it might be to use Nadex spreads. Sometimes it might be to trade the underlying. But to be a trader who has a solid approach to all of these things, I think it's important to understand the differences between the different products that we have available to us for a trade setup. We're going to focus, like I said, more so on the actual binary options applications to these setups, and we'll go over a trade that I actually did today, and just give me 1 second to pull that up so I have it ready. We'll go over a trade I did today based on a signal in the Aussie dollar Japanese yen pair, and we'll take a look at other markets that you guys might be interested in as well. So we're going to have a quick kind of overview first of the Ichimoku cloud, which is a technical indicator that I use for this trading plan. And then we're going to kind of jump right into some examples, and I'll take questions from you guys. We'll take a look at all the different things and approaches that we can use to trade this plan. Okay, so before we do that, I want to read our standard boilerplate risk disclaimers. Okay. Trading on Nadex involves financial risk. It may not be appropriate for all investors. The information presented here is for information and educational purposes only. Please contact your broker or a registered investment advisor for any questions about these things. No trade that we discuss here is considered an offer or solicitation to buy or sell any instrument on Nadex or elsewhere. Decisions that you make are your responsibility. Past performance is not indicative of future results, and Nadex binary options and spreads can be volatile and we'll talk about that a little bit more as we go on here. Investors risk losing their investment on any given transactions. However, the limited risk nature of Nadex contracts ensures that an investor cannot lose more than the cost to enter the transaction. Nadex is subject to U.S. regulatory oversight by the CFTC. Day trading, short-term trading, options trading, swaps, and futures trading are extremely risky. And this is essentially going to be saying the same thing, right? Your decisions are your own. We're not held liable for anything that you decide to do with your own trading account. Everyone watching this presentation adheres all disclaimers on Option Hacker and AlphaShark.com as well. Okay, so my name is James Romelli. I'm a trader and educator here at AlphaShark, where I actively trade equities, options, and currencies, and all of the binary contracts that go along with those as well. Regularly on CNBC, Bloomberg, Fox Business, BNN Canada, and I also write for Futures Magazine, Active Trader Magazine, Resource Investor Magazine, CME Open Markets, and a bunch of other online publications. So maybe you've read something I've written in the past, maybe not, maybe you've seen me on TV, maybe not, but we're here today to talk about some of the plans that I use and the technical analysis methods that I have for these particular plans. And basically where we are right now and the type of market environment that we've been trading in, I've been focused a lot more on this type of trading plan where it's based pretty much solely on technical analysis and support and resistance, looking for day trade setups. Because what do you guys think in general in the broader market, and we can talk about any financial market, commodities, equities, currency pairs, do you think that we've been in a strongly trending environment right now, or have markets been a little bit more choppy over, say, the last 4 weeks? Are we in a really strong, drawn-out trend, or have markets been a little bit more choppy over the last couple of weeks? I, for one, think that they've been a little bit more choppy. And kind of the long, drawn-out trends are harder to grab onto. But at the same time, binary options and the method that we're going to discuss here for day trading these products, I think works really well in this type of environment. So let's go ahead and jump right on in. What is the Ichimoku cloud? How many of you here have never heard of or seen the Ichimoku cloud before? How many of you have never heard of it, never seen it? If I put it up on a chart, yeah, so a good number of you have never even heard of it. That's awesome. You're gonna really like this because it lends itself so well to trading not only binary options but a number of other products that you're probably already trading. Now, for those of you that have heard of it, how many of you would say that yes, you could identify it if it was on a chart, but you wouldn't necessarily be able to explain it to me or to somebody else if I were to ask you to describe to me what that indicator, the Ichimoku cloud, is saying about the particular security that we're charting it on? I bet it's a lot more of you that kind of fall into that quick category there, where you'd be able to identify it. You've probably seen it. You maybe have even heard someone give an analysis using it, but you wouldn't necessarily be able to do it yourself. Yeah, and so I think this first part of this presentation, if you take nothing else away from this presentation today, I would tell you to make it this first part, how to use the Ichimoku cloud, and having an understanding of what the different levels are telling you, because regardless of whether or not you trade binary options or Nadex spreads, you'll be able to take that knowledge away and apply it to whatever it is you're trading. If it's individual equities, if it's Bitcoins, whatever, you're going to be able to use the info about the cloud to get a better understanding of trend and analysis there. And that's what's nice about the Ichimoku cloud, is that it's simple to use. It's kind of one of these things that I can explain to you in 30 seconds and get you to a point where you understand what you're seeing when you look at it on a chart. And I could also talk to you about it for 2 or 3 days with the finer points. But for the particular plan that we're going to be discussing here, the knowledge you need to have about the cloud isn't like an expert level of knowledge. I would say that, excuse me, I would say that in general, this is a simpler application of the cloud than some of the other things you might look out there. And what makes it so simple is that the Ichimoku cloud, even though it's looking at levels projected on the past, present, and future, to help identify trend, it's designed to be an indicator that all you need to do is look at the chart once to understand where we stand in terms of trend and strength of trend. So the full name of the indicator in Japanese is actually Ichimoku Kinko Hyo, and I'm sure I butchered the translation, or butchered the pronunciation, but literally translated into English, It means one glance equilibrium chart. And that's exactly what it's meant to do. I'm able to look at the chart and in 5 seconds, faster than that, tell you right away whether or not we're trading in bullish or bearish territory and have a good understanding of how strong that current trend is as well. Okay, so this is the beauty of the Ichimoku cloud. It's made up of 6 key components. Each of them are calculated individually and then plotted on the chart to create the overall study. We're going to look at how to calculate each of the components and what they're called, what they're used for. After that, I don't necessarily think you really need to have like a super solid understanding or even memory of what all the different names of them are and how they're calculated. Just know what they mean and what they're kind of telling us, okay? So here are the 6 components: the Tenkan-san line, the Kijun-san line, the Senkou-span A line, the Senkou-span B line, the Kumo, and the Chikou-span line. Each of these components is calculated and plotted differently on the chart, and how we interpret them might vary depending on the product, depending on the current setup. But what we're going to look at here next is an example of a chart setup with the Ichimoku cloud, and it's kind of an old chart. The only reason that I picked this was because it is a really nice looking chart, and in this webcast environment, the levels will be really easy for you guys to see and easy for me to label. Once we jump into live examples, you'll notice that not all charts look like this. This next couple of examples we look at are going to be very clear and very obvious what the trend is telling us, what the cloud is telling us, but it's not always that simple, okay? So just keep that in mind. Now, how many of you, now that we have this, tell me that you have seen this before, this study, but you wouldn't be able to explain it to me? How many of you? Just leave a little note in the chat box here. Okay, so a few of you, right? A few of you have seen this before. Can you use it for 5-minute Forex? Oh yeah, absolutely. And we'll jump into the examples of that in a little while here. So yeah, a good number of you have seen this before. Yeah, okay, so I'm glad you made that comment, Mark. So Mark basically just described, which I think is what he's saying is his knowledge of the Ichimoku cloud, and that is a somewhat limited interpretation of it, but guess what? That's the most important interpretation of the Ichimoku cloud. If you take nothing else away from this, make it this. Anything trading above the cloud here, above the shaded area you see, is in bullish territory. Anything below it would be in bearish territory. The line in the sand between bullish and bearish territory is this shaded area that you see here, right? Pretty simple. This is where the one glance component of this study comes from, right? I can tell right away whether we're above or below the shaded area on the cloud here and whether or not we're in bullish and bearish territory. So now if this is the line in the sand between bullish and bearish territory, what is my trade setup? Where's my entry? What is this telling me about when I might want to enter a trade? Yeah, exactly. It's pretty simple. I want to enter when we cross from bullish into bearish territory, or vice versa, when we cross from bearish into bullish territory. So the simplest way to trade with the Ichimoku cloud is to buy breaks to the upside and sell breaks to the downside as a short position. And then there's a bunch of other things I can do to kind of figure out the strength of each of these signals, but that's the simple application of it. And that is at its core what we're going to be talking about here in terms of a strategy. But let's jump into the individual components here and kind of explain this a little bit more. So the first component of the Ichimoku cloud is the Tenkan-san line, and it's a short-term trend line, similar to a 10-period moving average. But the way that this is calculated is by taking the highest high and lowest low, adding them together, dividing it by 2 over the last 9 periods, and plotting it under the current bar. Okay, this is a pretty fast-moving average, 9 periods. We're looking at this chart on a daily bar. So what we're looking at here in the calculation of the Tenkan-san line is actually 9 days worth of price action. The highest high and lowest low over the past 9 days are what we're including in this calculation. And essentially what this serves as in this particular example is our level of first support, right? It's a fast moving average. That should be a level of support. And as you can see, after we broke the cloud to the upside here, anytime we tested off of that average, it proved to be a pretty decent buying opportunity. So what a lot of traders use this for, if they want to be very conservative, is a level for a trailing stop. You can see that would have stopped this out pretty quickly. But in most cases, what traders are applying this line to is a level that they may want to choose to enter a new position if they missed the initial break, or a level that they could choose to add to their position. So let's say, I'm snapped into consciousness 4 days after the initial break to the upside happens here on this chart. Well, what do? Have I missed the setup? Am I just going to have to wait until another one comes across? Well, guess what? On the daily bar, that doesn't happen all that often. So in this case, I can use this as a level to enter a new long if I missed the initial entry on the breakout, or I can use it as a level to add to my position if I, feel confident during these periods of consolidation about getting more risk onto this particular trade, okay? So we're looking at the daily bar here. Obviously, when we jump into our examples, we're going to be looking at much quicker time frames here, where we're looking at how we would apply them to, say, a much quicker type of trade setup that would make more sense for binary options. But in this example, we're just going to use the daily because it's nice and visually pleasing. So after we know that that's our first moving average level of support, we have to have something to compare it to, and that's where the Kijun-san line comes in. It's a longer-term trend line. It's slower than our Tenkan-san line. We have a calculation that's being done the exact same way. However, instead of 9 periods of data, we're using 26. And again, this is our second level of support. When we're looking at this particular setup, if the 9 is above the 26, what does that tell us about the strength of trend right now? Is that a stronger setup? Is that a weaker setup? What do you guys think? Yeah, it's stronger, right? And not only does this give us a indication of how strong the trend is while we're above the cloud. Remember, everywhere above here is telling us it's in bullish territory. Rather than waiting for the market to break back below the cloud, what if we saw the 9-period moving average dip below the 26-period moving average? Well, that might give us an early clue or heads up that trend might be getting a little exhausted, right? Another application of this moving average is the same that we described for the 9-period moving average. For a trader that's a little less conservative, this could be a trailing stop level. As you can see, the trader would still be in their position after the initial break. Also, it can be used as a level to add on a more aggressive pullback, right? I typically think that it's better for a trailing stop rather than a position to add, a level to add on. But traders, again, can use it for all of those different things. So as you can kind of see here, as we add more and more components to the cloud, we have different things that we can check off of our list if we were to build like a chart and say, okay, here's how many components are pointing towards bullishness, here's how many are pointing towards bearishness. How would that look right now with the 3 things that we know about the Ichimoku cloud? Well, if this is the bullish column and this is the bearish column, what does the positioning of the stock relative to the shaded area show us? Is that bullish or bearish? That's pretty bullish. We're above the cloud. What about the positioning of the stock relative to the 9-period moving average? Well, that's pretty bullish as well. What about the position of the stock relative to the 26-period moving average? Again, we're above it. And what about the positioning of these 2 moving averages relative to each other? Yeah, well, that's pretty bullish too. So as you can see, we can kind of build these checklists using the Ichimoku cloud and a more and more complex analysis. When we add these components, they give us more things to check against each other to determine the strength of trend, okay? So let's move on to the next component. This is an important one because the Senkou span A and B lines basically form the bounds of the shaded area that you see here. And like we said, the shaded area is the line in the sand between bullish and bearish territory. Anything in between these lines is what we would consider neutral zones. areas where the market and the Ichimoku cloud really isn't telling us that there's any strong trend developing and really no expectation that there will be a breakout anytime soon. But the Senkou-span A line is essentially just a moving average of the Tenkan-san and Kijun-san plotted 26 bars into the future. So we take the average of these two lines and we plot it forward. So this is where traders kind of get confused. If we draw a line straight down to the Senkou-span A from our current bar, this point right here was actually plotted 26 days in the past. So that point of data is almost a month old. As we get the calculations and averages of today's Tenkan-san and Kijun-san, we plot that 26 days into the future. Okay, this is the forward-looking component of the Ichimoku cloud, all right? The Ichimoku cloud does not, with this forward-looking component, tell us a price level that it thinks the market or this particular symbol is going to get to at some certain point in time. All it's telling us is what the expected strength of trend is going forward into the future. Just like with our other two moving averages, we can take the Senkou-span A, which is a little bit faster at 26 periods, and compare it to the Senkou-span B, which is 52 bars worth of data plotted 26 bars into the future. And again, it's a slower moving average. So if the future cloud is upward sloping like this, what can we say about the expectations for trend? What do you guys think? Everybody that thinks they know, put an answer in the chat box here. What do you guys think? Yeah, right. The expectations are for this trend that we, see very well established here to continue, right? And we expect this trend to continue forward. Now, what if we get a change in the slope of that moving average of this shaded area? What if it starts to slope lower? The Senkou-span A is below the Senkou-span B now. Well, again, that would tell us that we might expect trend to start getting exhausted at these levels, right? So with that in mind, I can use the slope of the future looking part of the cloud to determine whether or not continuation is expected. And take a look at it when it gets flat here, right? Do you guys see how this is kind of, the Senkou-span B is on top of the cloud here, but two, there's not really much of a slope there, right? And take a look at how we traded through there. That was the longest period of consolidation on this entire chart that we're looking at, right? When it was trading above this flat component of the cloud. It's sideways, flat. And remember, this wasn't created by this sideways price action. This chunk of red here, this flat part of the cloud, actually would have been there already for 26 days before the market even traded above it, right? Traded into this region. And you can see that's when trend kind of started to slow down, right? As soon as we started to pick up here in these couple of days of bullishness, that's when the cloud flipped back up on top of itself and started to continue moving to the upside. Okay? Does everyone see that? Does everyone see that so far? Makes sense, makes sense. Cool. When I say 26 periods into the future, does that mean a shift of 26 periods? I'm not sure what you mean by that, Scott. So basically, the calculation for the Senkou-span A and Senkou-span B happens right now, okay? So today, using the data that we have for these two components, they calculate that level. That level is then plotted 26 bars into the future. So rather than plotting it directly below where we're currently trading or above whatever it might happen to be, we plot that 26 bars into the future. So this point right here is 26 bars offset from where we currently are. Does that make sense? So on the daily bar, it's 26 days into the future. On the 5-minute bar, it would be 26 5-minute bars into the future. On the 4-hour bar, 26 4-hour, so on and so forth, right? Okay, cool. So after we have the bounds of the shaded area here, it forms what is the fifth component of the cloud of the Kumo, the shaded area between the Senku span A and Senku span B. Some Ichimoku cloud practitioners and those that use this thing don't really put a whole lot of weight into the thought of analyzing how thick the cloud is here, or analyzing how the slope of the Kumo. I think it's really important, right? Let's say that we see two different breakout setups, and one of the breakout setups happens against a cloud like this right here, and one happens against a cloud like this right there. Which one is going to be of more significance? The one that happens through this really thin part of the cloud, or the one that happens through the thicker part of the cloud? What do you guys think is the more significant breakout setup? The one that has the higher probability of continuation, or the one that has the most conviction behind it? Yeah, the thicker part of the cloud, and that's just logical in my mind, right? I don't understand why some traders don't really care about the thickness of the cloud. Now, when we're above the cloud, like in this region, if I'm looking at trying to make a decision like today about this, then yeah, the thickness of this cloud probably doesn't really matter to me all that much, right? But when I'm looking and flagging a brand new breakout, that's a big deal, right? I can't have as much conviction in the breakout that happens here, right? Because in a day, I mean, look at the width of the cloud here in Apple. This is a chart of Apple, by the way. It's about $2 wide, right? Through the thinner part of it. How easily can something like Apple, or a currency pair, an indice, move this magnitude in a single day? Pretty easily, right? So I could see something go from during intraday, because the cloud is thin here. I can see it go from bullish territory to bearish to neutral to bullish to neutral to bearish, right? There's not as much conviction behind it. It takes more oomph to get, and price action to get through the thicker part of the cloud. Okay. Finally, the last component of the Ichimoku cloud is called the Chikou span line, and it's probably the easiest calculation of any of them. This is one that for sure a lot of traders disagree with the components that we have. A lot of traders won't even apply this to their charts, because all it is, and I can visually do this myself very easily, right? All this is a line plotting the current bar's price, but 26 periods offset to the past, okay? And really, the kind of classic Ichimoku setup is to wait for this breakout to happen here, but also confirm that the 26 period offset average, or the price that's going back like this, is also breaking the cloud to the upside, however many periods back. 26 periods back. Some traders will say if they don't get this confirmation, they won't take the setup. I don't think it's quite as important, especially in the setup that we're going to be talking about here in the next couple of slides when we start to go over examples. All right. So this is the final component of the Ichimoku cloud. Now, the next most important thing to understand about the cloud is its applications in different time frames. But before I jump into this, and then right after this, we'll jump into some examples. Before I jump into this, does anyone have any questions on anything we've gone over so far? I'll give about 90 seconds for you guys to leave questions in the chat box here about anything we've done so far. Questions, comments, concerns? Cool. Yeah, and we're going to talk about time frame here in a second. Yeah, so when I was talking about this, I said some traders would ignore this breakout unless the Chikou span line is also breaking the cloud 26 periods into the past. For my applications of this, I actually don't think that that's all that much important. I don't think it's as important. Some people like to use it as a kind of final confirmation against their against their setup, okay? Does that make sense? Okay, so let's talk about time frame. Now, time frame is really important with the Ichimoku cloud because this is an indicator that works best in trending markets. Now, let me ask you guys a question about two different markets. We're going to talk about two different products entirely. Do you guys think that trend develops on the same time frames for something like the Euro British pound currency pair and something like NASDAQ futures? Does one of them trade a little faster and one trade a little slower than the other? Yeah, exactly, right? They're two completely different things. They have different relationships with trend, and they move at different speeds. Currency markets, a lot of times, are a little bit slower, right? So finding the correct time frame for the Ichimoku cloud is important, right? Because it's a trending indicator that's going to give me the signal of a potential breakout. I want to be able to know that that breakout is happening on a time frame where trend is likely to continue its development after that, right? Now, one of the things that is kind of different about the strategy we're going to go over here is we make some assumptions, right? And these are pretty easy assumptions to make. Let's say that the broader trend, or how about this? Let's approach this a little bit differently. Do you guys think that in general, S&P 500 futures trend better on a daily bar or a 5-minute bar? What do you guys think? Where does trend develop a little bit better in something like S&P futures? Which is more choppy? Do we see trend develop better on the daily bar or on the 5-minute bar? Right, daily, right. But let me ask you a second question now. If trend is generally higher on the daily bar, what does that say about trend on the 5-minute bar? Does it have to be generally higher or no? Yeah, exactly. It's gotta be generally moving to the upside. If we were to plot it across a big, huge chart, it might have some more traps. It might be more choppy, but in general, it has to be trending higher, right? The smaller aggregations of data need to agree with what, they are what builds the higher time frame aggregations, right? If the 4-hour bar is trending higher, well, then the 15-minute bar in general is probably trending higher as well, right? Over a certain period of time. Now, this is what brings us to the selection of our signal bars. In general, equities take the best signals off of the daily. Anything faster produces too many traps. Now, we're going to talk about a strategy that I can use to take indices and trade them on a faster time frame, because like we said, the daily breaks don't really happen quite as often on indices on the daily bar. It just doesn't happen, right? There's only one bar per day. So that means there's really only one opportunity every day for the market to close above or below the cloud. And once we're putting some distance between us and the cloud, it's less and less likely that on a day-to-day basis we're going to get a new signal, a fresh signal. And especially when I'm looking at trading something like binary options, the daily bar is not really going to do a whole lot for me. So even though I know that that's going to give me the least amount of noise, I need to trade it on a faster time frame if I want to be active, right? Same thing goes with currencies. We think the best setups come off of the 4-hour bar. Anything faster than that can produce too many traps. But using this confirmation strategy that we're going to talk about here in the next slide, I think we can get to a place where we're getting good signals off of something as fast as the 15-minute bar. Likewise, crude oil futures, other energy contracts, we can trade those in the 5-minute bar. So really it's only about confirming them on higher time frames, okay? So I want to jump into the actual trading plan, and we're going to talk about some currency pairs here to start. We'll pull up some examples. But before I jump into this, I want to make sure that you guys are all kind of on the same page about the stuff we've talked about so far. Is anyone just completely lost or confused? Because we've got plenty of time here. If I have to kind of re-go over something, I don't mind doing that. I figure with the number of people in here, if one person has a question or is kind of lost right now, then there's at least a couple of other ones that do. Sorry. I feel like I'm coming down with a little bit of a cold here. Not that that matters to you guys. Okay, cool. All right, so Ichimoku Cloud is great, right? But we've identified a couple of problems that we would have applying it to a strategy that is focused more on trading intraday setups, right? The problem is the setups that we get in a lot of markets on fast time frames aren't quite as reliable because we know that trend develops better on higher time frames. Now, I still want to be able to trade these markets. I still want to apply the Ichimoku Cloud to my trading plan in those markets, but I need some way to increase my probability on lower time frames of getting into something that's not just a trap. So we know, based on what we talked about here already, is that if the trend in the higher aggregate time period, the daily, weekly, monthly, is higher, that the general trends in the lower time frames have to be higher as well. Vice versa if we're looking at something that is bearish on a really long time frame, right? The smaller aggregations need to make up this broader trend. So we know that in general, we're moving in a certain direction. We're generally moving in a certain direction on lower time frames. So all I really need to do to confirm a setup on a shorter time frame is make sure that that setup agrees with my higher time frames. Now, we call this idea triple confirmation. And really, you can add in as many levels of confirmation as you want. We think that, 3 of them is pretty solid. But a trader that wants to be more selective can add in as many as you want. There's no real limit to the number of time periods that I can aggregate price action over and use them to confirm, right? So essentially what I'm doing is picking a signal time frame, an entry time frame, 5-minute bar, 15-minute bar, whatever, and then picking 3 time frames above that to then confirm my setup. Okay, so let me pull up something here that I use to do this, and I'll show you guys how this works. So basically, what I am looking for are setups that are confirmed on multiple time frames, okay? And I'm going to show you this. Just bear in mind that this is an older sheet, right? Because I don't really need to use this anymore. But this is essentially what I'm trying to do, okay? Let's talk about Forex first. The trading plan is to trade off of the 15-minute bar. Now, do you guys think that in general the 15-minute bar is a little too quick for currencies? Is it going to be more trappy than the 4-hour bar? Is there going to be more false signals? Is there going to be more false breakouts? Is there going to be more noise on something like the 15-minute bar compared to the 4-hour bar? Yeah, of course. Of course. Rather than having, 6 bars total in a day, on the 15-minute bar, we're getting what? 48? No, more than that. 96 bars a day. So there can be quite a bit more noise. But I can trade off of that 15-minute bar if I have agreement in my higher time frames. So every day, and really I can update this every 30 minutes, I'm only looking to trade directionally in the pairs that have this agreement. And this isn't the current positioning of these things because I have built something that I don't need to use this spreadsheet anymore. I have it in my Thinkorswim. It actually does this automatically for me. But take a look at this. What this tells me right now is that the 30-minute bar, 1-hour bar, and 4-hour bar have some sort of setup relationship with the cloud. In this particular pair, it's above on all 3 time frames. So if all 3 higher time frames are bullish, 30-minute, 1-hour, 4-hour, what can I say about the probability of continuation on a breakout on the 15-minute bar? Is it higher or lower, stronger or weaker than, say, in this pair where not all 3 time frames agree? It's pretty good, right? It's stronger. I know that this higher time frame, the trend that's developing on the 30-minute, 1-hour, and 4-hour bar need to be supported by the trend on the slower time frames. I could pull this all the way down to like the 1-minute bar as well, right? Same thing for this particular pair, pound yen. all of my higher time frames are below the cloud. So that means that the smaller time frame, the 15-minute bar, has to be supportive of this bearish trend that we're seeing on our higher time frames. Now, trading the 15-minute bar and checking them against these, yeah, that's a great way for me to get signals that I can use for day trade setups. Now, let's say I just wanted to tweak this. I only care about swing trades. I'm only looking to trade weekly binary options. Well, maybe my signal time frame is the 4-hour bar, and I'm confirming on, say, the daily, 2-day, and weekly bar, right? Now, again, all of these higher time frames, if they are in agreement, well, then my 4-hour bar time frame is most likely supportive of this broader trend, okay? So it's a stronger signal. Does this make sense to everybody so far? And just notice these are the pairs that are all listed, have listed binary options. So let's take a look at a setup that I took as a day trade this morning. This is the indicator that I've created for Thinkorswim. And essentially all it's doing is taking the signal time frame, in this case the 15-minute bar, and checking it against higher time frames on the Ichimoku cloud. Okay? So if I have a break of the cloud to the downside, what this indicator is going to do, and here's the downside break right here, what this indicator is going to do is check the positioning of the time frames above it. In this particular example, I'm using the 30-minute, 1-hour, and 4-hour bar. Since I'm signaling off the 15, I want to have, quote-unquote, quicker time frames that I'm confirming, because I'm not looking for this, like, humongously broad move, right? I'm looking for a move that makes sense in the 15-minute bar. Now, in this particular example, we broke the cloud to the downside with a confirmation on the 30-minute and 1-hour bar. There is no dot here, so that tells me that the 4-hour bar was inside the cloud while that happened. So bearish break on the 15, bearish setup on the 30 and 1-hour bar, neutral setup on the 4-hour bar. Now, typically, I would not take this trade because I don't have agreement on all 4 time frames. Now, it just so happens that I have another indicator here, the one that fired this little red arrow, that looks for consolidation and breakout of consolidation. And when I saw that fire as well, the bar that happened right after the close of this one, I said to myself, okay, 2 out of 3 is enough for me. I'll go ahead and take this particular setup here. And I went ahead and I did it with a binary options trade. And here's the trade that I took this morning. I sold the 84 spot 63 12 p.m. binary options, and we closed below that. So I collected the whole profit, right? So there was also another example this morning, and I want to say it was in Canadian, USD Canadian. Yep, here we go. Where do we go? Maybe I was mistaken. But in any event, we can go back and take a look at the signals that we get, right? This is a good one from Friday. This happened, Thursday, pretty early in the morning. And on a 15-minute bar, we see the break happening here. Now, my entry would be the close of this bar. And as you can see, all the time frames above this agreed. And what did we see? Some nice follow-through. On a 15-minute bar, would anyone scoff at this move to the downside? Clearly, the market rallied back, right, eventually. But, is this an insignificant move on a 15-minute bar? I mean, it held this downtrend and stayed in this bearish channel for what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 15-minute bars. I'd say that's a pretty nice trade. Trading binary options here would have been a slam dunk. My first entry on any of these setups is what? If I have a signal that's saying, hey, on the 15-minute bar, we're breaking lower, and the higher time frames are supporting that break lower, what is the easiest and most simple and natural binary options trade for me to enter upon receiving that signal? Yeah, to sell in at the money, right? I just need to find a strike price that lines up with this short signal here. And then guess what? All I need is for the market to continue this move lower. It just needs to get below where we are right now. And typically speaking, what can I get in terms of a risk to reward ratio on an at the money binary option? what is my risk reward going to look like typically in an at the money binary? Yeah, about 1-to-1, right? And let me ask you guys this, and this is a super simple way to take this plan and apply it right away. Let me ask you guys this. If I take a 1-to-1 setup right here, and all I need is for the market to move maybe a couple of pips to the downside to make my 1-to-1 profit, how would I then take that and translate it into something that I could use in the spot market? Well, I would take a short right here with a stop loss 1 to 2 pips higher, right? Can I have any confidence that that trade's going to hold up? If I have a 2-pip profit target and a 2-pip stop, do I have any confidence that that's going to hold up? By the end of the day, is there any? I mean, what is that? That's basically just like flipping a coin, right? That would just be gambling, taking a trade like that in the spot market here, right? Hopefully it ticks lower before it ticks higher. Maybe I won't even be able to do that trade given the spread in the underlying market, right? So it's impossible to replicate that 1-to-1 reward to risk ratio with such a small required move in the underlying using something like the spot market. I have to approach it with binary options to have that same type of trade setup, right? And likewise, I could pull up like, the Nadex spread here and say, hey, maybe I just want to have a directional move where I'm going in looking to sell a Nadex spread that makes sense at this price point. And then I still have my protected level. Now, if I was trading the spot market, my entry would be pretty simple. I'd get short here with a stop somewhere above the cloud. Now, to get the required reward to risk ratio that would compare to a binary options trade, typically I'm going to have really big profit targets, whereas the binary option will most likely give me the ability to take that same type of directional trade without having this like big, enormous move required to get a really good reward to risk ratio. There was another really good example from Friday into the close of this setup. Euro pound, we saw a signal right here. 9:45 in the morning, Chicago time on Friday. We actually had two, right? The first breakout was confirmed on higher time frames. The second breakout to the downside was also confirmed on higher time frames. And this was a huge move to the downside. We sold off and closed on the absolute low tick of the session on Friday. Fantastic signal. So does this make sense to everybody so far? Do we all understand the what constitutes the entry signal and then what constitutes the actual confirmed let me go ahead and take a trade here, confirmation level. Yes. Great. And just like with currencies, I can apply this to index futures as well. I can apply it to any market that I want. What's kind of the question mark here is taking the signals that make sense on their, the proper confirmation timeframes. Like for here, this is an example from Thursday morning. The market broke higher here. It was confirmed on my higher timeframes, and yeah, this ended up running for a nice chunk of points here, 61.5 all the way to 66.75 at the highs. Yeah, so I'm looking to confirm on higher time frames, right? Because it doesn't make sense going back the other way, right? It doesn't make sense going back the other way. Seems like a lot to watch, especially in a fast market. No, not at all. I mean, how often can there be a break of the cloud on the 15-minute bar? Every 15 minutes. But, it's not likely, like in this situation here in SPOOs, it's not likely that we get another break today, right? The market would have to rip to the upside, almost 14 handles. So it's probably not going to happen again today. The signals and breaks happened earlier this morning. And this particular indicator visually shows me the positioning of the cloud relative to all of this. So I don't even really need to do it. At the most, if I was doing this with, let's say, without this indicator, at the most I'm looking at 3 different time frames. We break on the 15, I pop up to the 30, I pop up to the hour, I pop up to the 4 hour and see where they're positioned. Now, this indicator that we have also gives me the ability to have a text message sent to my phone right out of Thinkorswim to let me know when the signals come across. But, even without it, I still don't think that it's that difficult of an approach, right? let's take a look and see here if we have anything that's kind of cooking or in the works here. And, most of the stuff has broken or has already happened. This dollar-yen one, Aussie dollar-yen one was probably the best setup of the day so far. Oh, so here we have one developing right now. How perfect is that? Okay. So what do we see here? We see kind of a choppy session in Aussie dollar, US dollar, right? Now, we have some testing of the cloud and some rebreaking to the downside. Now, what does this show me about the current positioning? Well, the 15-minute bar is going to break the cloud to the downside here, most likely, right? As long as it closes as a bear bar, it will be a break. And how about my higher time frames? My 1 hour bar, well below the Ichimoku cloud. My 4 hour bar, well below the Ichimoku cloud. And so is my 30-minute bar. So how do I feel about this signal right here? Do I feel more or less confident that the market will continue lower into the end of the day on the close of this bar? I feel more confident about this, right? So how would I approach this? This is when I would pull up my binary options market and see what's available to me here. Okay. So here we have the Nadex platform. If I can get my mouse to work for me, there we go. So let's find that. Let's find that setup, and we'll take a look at different ways to approach it. A little slow here. So that was Aussie US dollar. So since it's a 15-minute bar and it's developing as a fresh break, I want to give myself a little bit of time for this to work out. There's some options that are listed here to expire at 3 p.m., the 3 p.m. dailies. So they expire in about an hour and 10 minutes, okay? So pull this up. The markets here are a little wide for these. Let's see what I can get with going a little bit later into the evening. Here we go. So where is this market? Where did we notice this market? It's currently at about what? Spot 7.6. Spot 7.6 is where I would say we're trading right now. So how can I trade this and get a good risk to reward ratio on this short setup? Well, I'm going to pull up my ladder chart here. And here we see the same thing on the 15-minute bar. My first setup, always, as always, is going to be an at the money. So they're 45 at 50. I'm going to try to do it for 50. I can get the order ticket to come up. My platform, as you can see, is a little slow here while I'm trying to present to you guys at the same time. So let's put an offer out here for 50. That's not letting me. There we go. So here's my 50 offer. This is the at the money setup, 1-to-1 reward to risk ratio, right? This is the spot 760 binary option. We're right at the money right now. So if the market breaks lower, how much movement do I need for this option to be worth 0 at expiration? I just need the market to move literally like, what, 2 pips right now to get there. If I pick something further in the money, I can get a better reward to risk ratio. But see how easy of a trade setup that is? Could I replicate this in the spot market? Spot market's at spot 76009. I needed to move, what, 5 pips to the downside to get below this level to get a 1-to-1 reward to risk ratio. Am I going to be able to do that in the spot market? Can I put a 5-pip stop to the upside here with a 5-pip lower target and hope to, let that trade live throughout the day? Probably not, right? So from this signaling and confirmation method, I can find all different kinds of setups across different time frames. Now, let's say that I wanted to focus on swing trade setups. Well, I'd switch this to the 4-hour bar, and I can use this to trade weekly binary options. Now my confirmation time frames probably would be something higher. So if I'm looking for signals on the 4-hour bar, I'm probably confirming on the daily, 2-day, and maybe weekly bar. And this will signal me to potential swing trade opportunities. When all those time frames line up, maybe there's a long to be had. When there's a break to the downside and they all line up, maybe there's a short to be had. All right, so I want to take some more questions from you guys because that kind of covers the main gist of everything, and we're running a little short on time here. But before I do, I want to give you guys a chance to get our ebook on trading with the cloud. This is going to have a ton of stuff in it about the Ichimoku cloud and how you can use it to trade different markets, and you're going to be able to take the knowledge in this book and apply it pretty simply to any of the markets you're trading with binary options. I just kind of showed you guys how easy it is to do that. I think you're not going to have a problem with that. So any questions here, guys? I put the link in here. It's completely free. You just go there and fill in your email address, and the book is emailed to you right away. Yeah, we do. Scott, just send me an email. Excuse me. We're in the beta release phase of that new indicator, which means that we have it for a pretty nice discount right now. All of what you've seen here today is actually completed and ready for it. What we're working on is the addition of the scan that comes with it that can alert me to this, and I can build watch lists for different swing and day trade setups to have it alert me in real time to when they're coming across. Alrighty, guys. Yeah, feel free, Kelvin. Feel free. My email is james@alphashark.com. So any questions, guys? Any other questions? Any other questions? Comments, concerns? Is it necessary to adjust the parameters to fit certain timeframes? Yeah. No, do you mean the actual calculations of the levels? If that's the question, then no. We always use the standard default settings of the cloud as they come. There's actually been a little bit of research done into how changing them might change the things that we would see and the indications, but typically what those have produced is a different results that aren't any better than what we would expect to get. Any other questions, guys? Yeah, it's not available for interactive brokers because they don't really have like a custom charting package that you can use. Any other questions? Any other questions? Any other questions? Someone says, please explain again why I did not choose a 3 p.m. expert. Oh, I mean, it was the market. The markets just were a little wider. That's all. And there wasn't a market on the strikes that I wanted. That's all. Alrighty, guys. Any other questions? Any other questions? Alrighty, so I'm going to leave my email in here again one more time, and then I'm going to say bid you all adieu. We actually have another webinar next week that will kind of be an extension of this topic, and I think we'll probably focus a little bit more on applications for spreads rather than just the outright binaries. So I think you guys will find that interesting, particularly if you find the spread product interesting, and I certainly do. It's a really, really cool way to approach these markets. So, all right, guys, I will see you all next Monday. Until then, everyone have a good one. I'll put the link in here again for you all to get the ebook for free. Check it out. It's completely free. It's free. It's free. And I will see you all next Monday. Thanks, everybody.